Today we're talking about deep research and finding alternative data. My guest today is Gary Hui, a portfolio manager at Geometrica Fund, a Sydney-based global long-short fund. This was a fun conversation. Gary doesn't buy into any of your typical market narratives. He wants hard data. In particular, I enjoyed how he waved off the narrative of founder-led companies. In this episode, we talk about A2 Milk, one of Geometrica's best shorts, and the sheer amount of data that went into confirming their view. They tracked the shipping data and even created thousands of bots to survey WeChat users. We also talked about ResMed, another successful portfolio position sold down on the back of market narrative around GLP-1 drugs. But in Gary and the team's view, this was not the real reason. If you jump on the Geometrica Fund website, you'll see examples of their research, and I've got links in the show notes below. I hope you enjoy this episode with Gary Hui from the Geometrica Fund.
As you know, Term Plus recently came on as a platinum sponsor of Rask podcasts, and I invested a small amount myself, $2,000 to be exact, to get a feel for it. After all, I couldn't tell you to consider it if I hadn't at least considered it myself. And the result is it's a very, very good platform. It's potentially the simplest technology platform that I've come across in Australian finance. And what makes that extra special is, behind the scenes, something very sophisticated is actually happening. Term Plus is investing your capital in a globally diversified and professionally constructed portfolio of private credit designed to produce attractive and reliable monthly income. Aside from providing passive income, what really attracted me to partnering with Term Plus now is potentially falling interest rates. Because Term Plus starts by targeting 3% returns above the RBA cash rate for a 1-year fixed term account, there's a buffer in place even as interest rates fall. Monthly income can also be paid directly into your bank account or reinvested for compound returns. I see Term Plus as a really neatly packaged way for retirees or even accumulators like me to get exposure to professionally constructed global private credit portfolios. You can find out much more information and grab a hold of the PDS and TMD at termplus.com.au. If you want to just check out the website, you should also know that there's an instant chat function for questions, which is really important and I find really handy before I invest in anything. Don't forget to tell them Rask sent you. And as always, consult a licensed and trusted financial planner who can take into account your financial goals, needs, and risk appetite before investing.
Gary, let's start off with the Gary Hui story. Where did you grow up? And can you maybe tell us some of your earliest memories of investing?
Yeah, sure. So thanks, Mitchell. So I grew up in Auburn and Granville. So I went to Granville Boys High School. Yes, I guess it's, I didn't go through a mainstream experience in that regard. But I had a great childhood and actually I think a pretty good education. And then my earliest interest in investing really came about actually through a period of time when you had characters like John Spalvins and Ron Briley and some others that were figures, I guess, of that period of time. And I was intrigued by possibly the wrong things, but some of the complexity around what they were doing and just trying to understand it as a, year 10 or year 11 kid, actually. And I distinctly remember my first equity investment, which was a total, it was a great success. And my second equity investment was a total failure and dud. So I made probably 60% on the first thing and dusted the whole lot on the second.
What stocks were they?
It was a gold stock and then it was a medical stock.
Everyone starts in resources, don't they?
In Australia, I think they do, yes.
When you say you were maybe attracted to all the wrong things, when you say the complexity, why do you say that's the wrong thing?
Well, I think at that point in time, you had a lot of figures that were involved in active M&A. And so rather than organically create value, they were buying businesses and ripping them apart and using leverage often to do that. And so that was a time when you had figures like, Mr. Bond. You had large takeovers that went ahead and then didn't go ahead.
Like, was it John Elliott?
Yeah, John Elliott was around,
Yeah.
so he's got that famous. I mean, he was quite a character, obviously, a very smart man and a character, and he had that wonderful expression, which is when he didn't agree with something, he'd say "pig's ass." And so I think that period in time was a lot more entertaining for the size of the characters that were at play, and I guess that movie Wall Street. I remember they played it in 1987. I think it was the day before or the day after the crash. I remember actually watching it, but
Like in the cinema, kind of like
on TV,
on TV, right.
yeah. And so there's this massive pantomime and theatre going on with all these larger than life characters, and so that element was attractive. But I guess my epiphany through time has been that good investing probably isn't that exciting. It's just a process. You stick to it. It can be rewarding at times, unrewarding at other times. But if you hew to a process that has logical basis and works, you should come out better rather than what you would have otherwise have done. So.
How did you come to that part of your process? Was there any early mentors, or what's that early career look like for you, Gary?
I started as a accountant, actually. So I qualified as a chartered accountant, and then I had a colleague who got a job at an investment bank, and I wasn't even sure what an investment bank was, but she told me what she was getting paid, and so my motivation levels jumped forward, and so I got a job at a firm called JP Morgan back in 1999, and that was a phenomenally positive and good experience, actually. So I learned a huge amount of technical things around valuation, finance, accounting, and I'm sure they do to this day, but the company at that point in time invested very heavily in their people. And so they sent us all across to New York for training and things like that. And so that was a really, really great experience.
Yeah, fantastic. And so let's take a step back. I like to ask a really broad question now, because I feel like this brings out a lot of interesting answers that we can unpack. To you, Gary, and maybe to the Geometrica Fund, what makes a good investment?
It goes up.
It's pretty simple, isn't it?
Well, I believe there's a false dichotomy in markets where people talk about growth versus value, and it's a talking point. But I recall being, and I used to work at JP Morgan, as I said before, and I was in equity capital markets, or in the parlance of that industry, ECM. And I used to go down to the trading floor and talk to all the analysts. I asked a quantitative analyst one day, I'm just curious, what determines a growth stock versus a value stock? How do you define that? And this person said to me, well, the value stocks are all trading on under 20 times and the growth stocks are trading on over 20 times. And to me, that's an entirely arbitrary delineation. There's no causality whatsoever there. So to me, if a stock goes up and you bought it and you made money, when you look back, it must have been good value because it went up.
It's that, yeah, that's simple. Now let's talk through the actual Geometrica Fund process. I've read the process, at least a brief version of it, and you look for situations where the market is materially incorrect on the future earnings of a business. So it's a little bit more deeper than looking for something that's going to go up. So how do you actually screen for that in your practice?
Yes, so I guess we have this conception or idea that a stock price is a simple derivative of earnings times a multiple. And the multiple is often a barometer of popularity. So its valuation is, to us, kind of like a popularity contest. And so there's one aspect in the job where you're trying to determine what the future earnings are. And all analysts, tend to do this. They tend to make forecasts and try to predict future earnings. But it's really the unexpected changes that drive a lot of realization of value through the change in the multiple. So all we do is essentially look at situations which are far from equilibrium. So we look at things where a stock might have fallen a long way, or there's some controversy, or we look at some new business that's growing really, really fast, and it's controversial again, and people don't understand it. And some people say it's a bubble, others say it's fantastic. And when we find those situations, all we do is go really deep on fundamental research and on logic, in terms of sequential logic, to understand what's actually going on, and then test those findings against what we see in popular perception as barometered or proxied by research, sell-side research. And if we find we have a different perspective and ours is mathematically driven, we can invest. Otherwise, we don't invest.
Or sometimes you could potentially short as well, because your fund is a long-short fund.
Yeah, that's correct. So that is entirely correct. And the best shorts that we've found have often been, or almost invariably been situations where it's considered a long, and we've actually come at it with an initial bias, because all perspectives are biases, with a bias of it's potentially a long, but then the detailed diligence often disabuses you of that notion. And there's a couple of hallmarks, or some people call them red flags, or this, narrative shift, or whatever you want to call it, that might mark it as a situation where consensus is actually wrong. So,
what are those, boss, we're here? What are those red flags?
I think it's probably best to give it in a situational context or an example.
Yeah.
And so we had one that you referenced earlier, which was a company that made infant milk formula. It makes milk as well, but it made infant milk formula. And they had what I would call a channel stuff, where their business is they sell to distributors, and then the distributors sell to the end customers.
This is referring to A2 milk, which is an example that you've got on your website and that we had a chat about. Yeah.
Yeah. So that, and this played out a couple of years ago. So I'm sure the company's fantastic, and I haven't looked at it in any detail whatsoever recently. But back then, there was a channel stuff where we think, based on the evidence that we saw at the time, that there was too much inventory, and the inventory was aging with the distributors. And our conception of the mental model was the end customer was still buying. It's not like all the babies stopped drinking milk, right? So the end customer is still buying, and provided you look after the profitability of the distributor and make sure they're making money in buying your product off you and selling it to a customer, you're going to be okay. And we'd had a very similar experience with a company called Bellamy's, where some people thought it would go to zero, and we made a lot of money.
Oh, so you were long Bellamy's?
Yeah, and this Bellamy's played out a few years earlier, but I can reel off a number of these models or situations where there've been channel stuffs where a company's recovered. So the same thing happened.
Can you explain a channel stuff to people that aren't familiar with that term?
Yeah, sure. So if I'm a manufacturer, I record a sale and therefore profit when the product or the service passes from my control to the customer's control. And in this situation, I'm selling the infant milk formula to a Daigou or a distributor. But back in the day, CSL, same thing happened to them back in probably 2001, 2002. They were selling IVIG and albumin, but principally in value terms, IVIG, to a whole bunch of distributors in the US. And if the distributors are buying product faster than the end consumer can consume it, by definition, their level of inventory is growing, unsustainably so usually. And that also means that the sales of the manufacturer are unsustainably growing and excessively healthy, in inverted commas, as well. And so that sooner or later has to correct.
So that build-up of inventory constitutes a channel stuff.
Yeah, and that's really our nomenclature, or our term for it. But you see it time and again. So you saw it with lithium and spodumene in China. You just see it because there's a signal to the distributor when the prices are rising that if you buy it for $10 and a week later it's worth $20, it's made a lot of money. So you're not in a rush to sell it. You kind of sit on it a bit. And this happens with, as an example, I'm pretty sure if the price of gold crashed, I'm not presaging that, right? But if the price of gold went down a lot, you'd probably find that a whole bunch of pawn shops that buy jewelry have been making inventory gains on gold through this period, and that would unwind, right? So you just there's no science to it, right? It's just common sense.
That's fantastic. So we will get into that because there's actually, I understand that, you go into there's a lot of research that goes into getting that data and actually verifying the investment thesis for yourselves. And we'll get to that. So when it comes to understanding your investment process, for that rapid change, you're looking at either extreme. So there's a company that has increased dramatically, or maybe a company that has decreased quite dramatically. And you mentioned that value or valuation is a proxy essentially for popularity. Can you explain that idea as well? And do you think investors tend to bend their valuation models to justify owning, say, popular businesses? Is that what you see?
Yes. There are obviously a lot of participants in the market at any one point in time, but you can see it. It's evident in numerical evidence. And so if you look at any stock that is popular and the earnings are growing and they repeatedly beat expectations, you will invariably see an earnings multiple that keeps going up through time. And so you're just attracting more and more people to the party, for want of a better term. So then at some point, invariably, you find that company that's beat expectations for a long period of time might just meet expectations and the stock price falls. But conversely, you can find situations where a company is unpopular and the market becomes conditioned to disappointment. And if they don't disappoint and they don't beat, they just meet their own guidance, the stock goes up. And so it's really around that expectations gap. And I think that one of the greatest investors who's not thought of as an investor but was thought of as an economist was Keynes. And Keynes initially, when he started investing, one of the smartest men at the time, lost a boatload of money, but then came up with quotes like, the market can remain irrational for longer than you can remain solvent. But he also said that the secret of good investing is anticipating other people's anticipation. And there's a lot to unpack there, right?
So that's how did you come to this part of your process? What were there any experiences or instances through your career that this really became a core focus for you?
Yeah, I just wasn't making money, quite frankly. So I was, I'm not a dummy. I'm not the smartest guy in the room, but I'm not the dumbest. But I wasn't making money in my personal endeavors, right? And so, and I would get wrong-footed. And I remember buying stocks that were really cheap and they weren't going up. And I'm like, what the hell's going on? And so, and then bizarrely, then I'm a nerd, right? So I would come home at night and I'd stay up and I'd look at, I'd just look at screens, but I wouldn't look at screens in the context of looking at something happening right now. I'd go and look at a stock that had gone up a lot over, say, 2-3 years. And then I'd go back a year or two and look at what research analysts were saying about it. And I'd measure the degree to which they were wrong about the future in their forecasts and then decompose where precisely they were wrong. Because then you see what they're missing, right? And so you just see these patterns that build up through time by industry often in terms of what they miss or what changes. And so, a lot of humans, a lot of machines now as well, but a lot of humans in the mix, and they're all fallible. Everyone makes mistakes, which means there's always opportunities.
Right. So did you compile that data for yourself or did you just anecdotally put the evidence together, or did you actually compile that data and say, look, geez, it's quite obvious? Often, so the two kind of areas that we target is like, and we're not the only ones that do this, but there's a company that, I would say falls out of bed or the share price falls because something's gone wrong. And the market or, the marginal buy and sell on the day decide or price in that that's going to continue for some long period of time. But it might be fleeting, or lo and behold, management might change. Someone else might come in with a better idea, or the existing management might learn and just change. And so those are opportunities, or the ones that grow fast as well.
where it's unexpected or opportunities, or maybe they have a different or new business model. And so by virtue of just going back and looking at stocks that went up a lot, I mean, CSL, like, I don't know, Telstra, any of these things that went up a lot over any period of time, just go back 2-3 years and see what the market missed. And that gives you a mosaic of how things can pan out that can be different to consensus perspectives. And then I would say I would call it an insight, and I hope it's an insight, but one of the lessons has been that often the reason for why people think something has fallen is not the actual reason the share price has fallen. And when you find what I would say is a logic inflation there, those are really interesting situations because the market's wrong, right? So,
can you give me an example?
Yeah, sure. I'll give you an Australian example because it's obviously translated a lot. We don't do much Australia, but
yeah, you're global. You don't ignore Australia. You can invest in Australia, but you've got the world to as your investment universe.
Yeah, and it's in a lot of developed markets, you have quarterly data as well, and so that means you have twice as much data than half-yearly data to feed a model or a screen to try to find things. And so it's easier to prove and it's less risky generally. So the example I'd use in the Australian context is perversely a quarterly reporting company because it also is listed in the US and it's called ResMed.
Okay, yeah.
And so I think it was around August 2023, ResMed fell, the share price fell. And it fell because on a particular day when they reported earnings, the earnings missed and the gross margin missed. But the market then latched onto the narrative of GLP-1s, and there was a thesis that GLP-1s would kill ResMed. And that was topical at the time because a company called Novo Nordisk just had a trial called the SELECT trial, which was a really big hit, a really big deal. And that drug was therefore approved for use to treat, potentially to treat obesity as a comorbidity. And so the market reasoned GLP-1s, ResMed must have fallen, the share price, because of GLP-1s.
Well, that's what the financial media put out there. That's what a lot of analysts were saying. And I guess a lot of people take that verbatim without doing the work themselves.
But the problem is, though, with that theory is that in this context, is that the drug had just been tested but wasn't being prescribed for obesity. So it can't have driven down the sales, or the earnings of ResMed. And then, so then you go through what went on, and this is a complex one because there's a couple of layers in there, but in the context of near-term earnings, if you look through what was going on, ResMed had a massive spike in their inventory and the composition of the inventory changed. So if you just pulled it up on, if you pulled out the annual report and you passed the different periods and shoved the numbers into a spreadsheet, you would see that raw materials spiked up through this period of time. And around the time of the inventory surge, the gross margin fell away. And there's a natural flow there because obviously the inventory and the unit cost embedded in inventory flows into cost of goods sold, determines gross profit. And so if you went back and looked, you would have seen that Philips Respironics, which was the arch competitor of ResMed in the US, had a product recall. They had some foam coming loose in their machines. And so we deduced that, and we tried to get a call with ResMed, but they didn't want to talk to us. And then I actually went through another much larger fund that I'm quite friendly with, and they couldn't get a call as well. But anyway, we deduced that ResMed must have bought in a lot of inventory to try to capture the market share of their competitor that was sidelined at the time. And when you dug into the composition of the inventory, the part that was raw materials versus finished goods, that mix shifted quite dramatically, which told you as well it was unusual. They were sourcing long. And so you'd also know if you go and you try to ramp production rapidly, and you might be having to call in new facilities, et cetera, there are additional costs that go into the inventory that must flush out into the cost of goods sold. And if those are higher on a unit cost basis, they hit the gross margin and report a profit. So that's a short-term episodic situation. It's got nothing to do with GLP-1s. And so that cures itself as you become more efficient and scale up. And so you see the pattern if you chart the inventory and the gross margin. They're almost a mirror image through this period of time. And then there is a truism, though, in the negativity around GLP-1s, in that the population of people that were using CPAP machines, there's a strong crossover or correlation between sleep apnea and BMI, obesity. And so if everyone who is using a CPAP machine takes this drug, then lo and behold, people might fall out of that population. But what people obviated away from was that greater diagnosis levels as well would increase the population, notwithstanding the fact that people are falling out of the population.
Well, that's now the narrative as well that played on from the, well, GLP-1s are affecting ResMed. And then the next narrative, when the recovery starts to happen, it's, well, now GLP-1s are aiding that. So it's funny that they're probably wrong. The narrative's wrong on both sides. However, it's kind of suited the movement of the stock. But if you dug into it, how did you get conviction around and confidence in that they were going after Philips's market?
So, your comment was incredibly insightful because the conflations can work for you and against you. And so you have to be aware of what the market thinks versus what you think, and how that can change through time. So the honest answer is, in these situations, there's an element of uncertainty. So you're never certain. You never know the outcome until it occurs. And by virtue of the fact that the company wasn't inclined to talk to us, a small fund, or to $5-6 billion hedge fund as well, we were unable to really get that confirmation. But if you eradicate, it's kind of Occam's razor, right? If you eradicate all the other possibilities, you're left with the simple and the obvious, which explains the facts, and that's the best answer you've got. So.
Yeah, fantastic. We're going to get into that a little bit more as well, but I want to talk to you about asymmetry and volatility in your portfolio. Can you walk us through how asymmetry plays a role in your portfolio?
Yeah, sure. So, we've been fortunate to have a relatively low correlation to the market, notwithstanding returns are comparable to market. And you might initially think that that's through some magic of hedging or, some really clever thing, but it's not. It's just being invested in stocks where there's what I would call active price discovery, where hopefully the market is changing its perception and the multiples changing around a given stock. And so we're always looking for situations where the upside is greater than the downside. But in the context of consensus, that actually means that people have to think you're crazy when you do that. So, because if you're agreeing with everyone else and your numbers are the same and everyone thinks it's going to go up, then it's already in the price by definition. So again, the asymmetry is in finding situations where you think it's a mouthful to say the market's wrong, because it's almost hubris in one respect. But if the numbers show that and logic supports it, then that's a good place to be, because usually there's more upside than downside.
So essentially, when you're looking for these contrarian plays, you're taking a position when you're going long in a business that has already been beat up. Expectations are quite low, so therefore it's actually got a bit of a natural baseline. And so you're coming in when it's already experienced that. And so it's hard for it to, disappoint much further, disappoint the investment community much further.
Yeah. So on the one, I would totally agree on the one side of the barbell, which is the thing that's fallen out of bed, or, that's in tough times. I would also say, though, that it's very difficult to pick that bottom, actually, really difficult. And so, so we would normally constrain position sizing around that point. We're pretty happy to miss the first move,
You don't need to be
3.
the first to the party, so to speak.
Because I don't want to be on the bleeding edge. Happy to be just behind the bleeding/leading edge. And so there's plenty of stocks, these situations where we stalked them for a year or two and just kept an eye on them. And then when things start to turn, then we really ramped the work effort up. But I would also say the other part of the asymmetry isn't just the train crashes, it's exponentiality. Because humans think linear and project linear and don't do so well with exponential. And you can make a lot of money out of it.
Can you give me an example?
The greatest one of the greatest examples. Unfortunately, it's not me. It's Paul Allen actually and Bill Gates. But I think Paul Allen's genius was understanding the exponentiality of the 80/80 of CPUs, Moore's law and sort of stuff. So and how like massively falling unit costs of computational power would drive massive adoption. And so, and that just keeps going and going and going. And people, it's like if I walk in to the office, there's lots of, screens, green, red, phone rings, urgent. And it's easy to confuse what is urgent and what's important. And the things that are important subsist and persist for some period of time. Urgency is noise, right? So it's very hard to delineate. But the important stuff, it's important. And so that this is the genius of Paul Allen and Microsoft to attach to an exponential thing on a one-to-one basis in the way they built their business model to sell software one-to-one to a box and leverage that. Yeah.
Fantastic. Now, let's get into, so just wrapping up on the volatility and the asymmetry. I'd say so because of your investment process, that lower volatility is more of a byproduct of the investment process and not something that you actually seek out and say, hey, let's keep this within a, we're actively seeking to do that.
100%. It's like it's the same as trying to find these asymmetric situations. We're not really we're not saying we're smarter or we can predict the future better than the market, and therefore we know what's going to happen. We're just looking for things that are far from equilibrium and then just testing we can measure what the market thinks because there are proxies for it. And then we just look at what evidence says. And, 9 times out of 10, market's right. 1 times out of 10, it's not. So that's going to be profitable.
Let's get on to that evidence because I find that's quite a fascinating part. You seek out alternative sources of data. So firstly, can you explain what you mean by the alternative data in the context of your investment process?
Yeah, so there's a lot to unpack there. So I would just say that the value of data is inversely correlated to its availability. And so this is the great irony in a business model where people sell data, because the more people that buy it, the less value there's in the data usually. So, but the value of the data also is determined by how pertinent or relevant it is to a problem. And so we don't come at a situation from trying to collect all the data in the world because that's not possible. All we're doing is trying to define what the problem is, and the problem invariably distills down to a couple of simple variables, and then trying to see, and you can't always get it. It's actually quite rare that you get really high quality, what I would call higher frequency data that correlates with the key earnings driver. If you can find that data and it's not widely used, it's very valuable.
And so that's why it's worth looking for. When you say it's incredibly rare, and you might go down a path where you've identified. So the framework, and this is what something that I was interested in, the framework for identifying those key pieces of data, because companies change there's different sectors, different industries, and then different companies within those. Is there a framework of how you sit there and go, hey, what are these core questions we're solving for?
Yeah, so we don't like to quit. We like to keep pushing and pushing and pushing in terms of logic and why things happen, and come at it from a lot of different angles. Because you really have to get the logic framing right to be able to ask the right question as to what is relevant data. And so, it's that. So I would actually say, relatedly, that most investment errors are not errors around sufficiency of information. If you go back and you look at why you got something wrong, the information was there, most likely. The error was in the logic framing. So logic framing is a massively important area for us.
Can you explain that logic framing?
Just sequencing. So the logic. In our investment process, we ban words like good company, bad company, good management, bad management. I don't want to hear any of that stuff. I just want numbers, and I want a sequencing between causality of numbers driving, sales mix, margins, blah, blah, blah. So it blows through the P&L logically, and there's some notion of causality. Versus good company, everyone needs their stuff. They must be okay. Let's buy it.
It's a high quality company. It's got good management. It's got skin in the game. Those things that have become almost cliche.
It doesn't tell me why the earnings are going to surprise. Doesn't tell me what the market's missing. Yeah. So I need that level of hard granularity before we invest. Actually.
So that's okay. So. Do you put much credence then in things like, founder-led businesses, skin in the game, that kind of thing? You're for people who are listening to this, you're just sitting there shaking your head. It's a fairy tale.
It's a fairy tale. It's like people telling you there's intrinsic value. It's a fairy tale, right? So, I don't believe in any of those things. I just like hard numbers that I can verify and directionality around them. That's kind of it. Yeah.
Fantastic. Can you give us some examples? Like I know you've got Carnival Cruises. We've talked about A2 Milk. I know if the A2 Milk, can you tell us how you dug into the port data?
So we don't usually share this stuff, right? Because the problem is if you share it, then it's dead, it's gone. But we did.
Yeah, and there's some examples on your website.
So,
yeah,
and that one totally.
Yeah.
We definitely shared. And so the first part of the work there was really just to understand the earnings picture and where the company made their money. And I would hasten to add that we buy the product. I don't have any young kids, but we buy the milk, right? Buy the red cap, the blue cap, and the light blue cap. So we're very good customers, but I'm pretty sure that A2 Milk made almost no money out of fresh milk. And so when you go through, and I'm a bit out of date here, but when you go through the numbers, i.e., the reporting, the annual reports, all sort of fun stuff, you see that the jewel in the crown was the infant milk formula selling into China. And then if you dig through the history, you see that occasioned by virtue of a couple of tainting or melamine poisoning scandals in China's history. And so parents had a strong preference for foreign high-quality infant milk formula.
It was a very strong thematic probably 8 years ago, I think. Yeah.
That sounds about right. And so as that played out, you imagine your infant milk formula, foreign infant milk formula industry goes from low market share to high market share. So you have a huge growth in market share, which is ultimately unsustainable because your category is never going to go above 100. And so that was an amazing period of time for those companies. And then if you look at how the product made its way into China, there were different regulatory rules. And so a lot of this stuff was going in effectively by people carrying it physically into China and then reselling it. And the term in Chinese is Daigou, which is like a carrier, right? It's a person who brings you something. And so you had individual Daigou, it might have been students. You actually had a couple of corporate ones. You had the biggest one in Melbourne actually at the time. You could see it in the annual report because there's usually a note in the revenue section of an annual report if a customer has more than 10% of your sales or represents more than 10%, that gets disclosed. And so that was in there. And so you got a pattern of of people carrying the product into China, either through organised means or in a suitcase, and there being over a period of time a large industry. And so there were thousands of people on WeChat that would sell this stuff. So when we looked at it, we just came at the problem from, first of all, trying to understand the business model and how they made money, which is manufacturing via a company called Synlait, 3 factories in New Zealand, which just happened to be next to 3 ports. The New Zealand government, God bless them, pretty open with information around some of that trade data. And so you can obtain that. It's a lot of it, but you can obtain it. And so you know what's going out of what port corresponds to what product. You can see where it's going. So you can, work out the trade flows. And then we also knew about the WeChat distributors. So one of my colleagues created several thousand identities on WeChat to talk to, the humans that were using it, to ask them a set of questions.
So you created bots on WeChat.
My view is in research, if you have a problem and the prize is potentially very large, you don't stop pushing. You keep pushing until you get an answer. So, we did this, or it wasn't me actually, it was my colleague James did it. And he got back a pattern which seemed to show a lengthening of the life of the inventory in the channel and a lack of profitability for the distributors in the channel. And then there were human cues around that same time as well. So normally in that situation, and I hearken back to Bellamy's in that same situation effectively took volume out of the distribution channel and effectively restored profitability for the distributors as well. So they were sure the distributors would make money, because if they're not making money, they're not going to buy your product. But A2 seemed to be doing something which was the exact opposite, which was pushing more in and giving incentives for distributors to buy more, which wasn't curing the problem. And then the company, and this is just our perception, because I'm vaguely aware that there was litigation, right, this area. The company had an earnings forecast out there, and the earnings forecast for any calendar period is just an accumulation of the monthly sales. And we're watching their port shipments on a monthly basis. And so if you see port shipments that on a cumulative basis are massively undershooting the number they need to get to, by definition, as each month passes, the sales need to accelerate at an accelerating rate for them to make the guidance. But as time passes, the likelihood of that happening gets lower and lower. And you can see, as correspondence to that the profitability of the channel is busted because the distributors are full of inventory. So it's not going to happen. And
at what point do you put your short on?
We put it on, I think it was in November actually, it ended up being a couple of weeks before they reported. And I would hasten to add that at the start of the process, we had a conscious bias where we thought the stock might be a long because it had already fallen a fair way in price terms. And we thought, okay, all the bad news must be out. Like, we've seen this movie before. No doubt they're doing these things that we saw this other company do. It'll be a wonderful long. But it was all the evidence that disabused us of that notion. But the real ringer was the differential disclosure between the Australian market and the New Zealand market. And so A2 Milk is listed on both exchanges. If we go deep, we kind of go deep. So I read every single announcement that company put out for a period of time, and I looked around New Zealand and we started doing the same thing. And we realised, and I didn't know this until then, but we realised there's different rules for disclosing what management buy and sell in securities. So I think it might turn on officer and director in the Australian context, but it's a lower threshold in the New Zealand context.
Oh, so as in potentially like management level staff and whatnot as well.
I won't say what positions, right?
Okay.
Or no names, but you could see it, and you could see a lot of it all at once around the time the company had reaffirmed earnings guidance. Actually, it didn't make sense. And so, listen to what they say, but follow the money, right? So.
That's fascinating. Gary, I'm just conscious of your time. What I want to do now is we always like to wrap up with a few reflections. And this is one question my colleague Owen always asks people for the first time that they're on the podcast. If you could go back in time and tell younger Gary a piece of advice around investing or business or life, what would it be?
That's a tough one, actually. I'd just say probably just think for yourself, think critically as much as possible, and never accept conventional wisdom. Actually, question everything. That's probably the advice I'd give myself. So
that's great. And more lighthearted, me and you, we're going to lunch. It can be anywhere in the world. The out of office is on. We're not going back. Where are we going and what are we having?
That's another tough question, actually. That's a very important question.
It is an important question.
I was implicitly a plug here, actually, for commercial enterprise, being a restaurant as well. So actually, I really like Rockpool in Sydney. I find that it's fallen away a bit, but has amazing, in the context of perceptions, but has amazing food and is, relatively good value, tongue in cheek. And then there are a bunch of, local restaurants around where we live in Sydney that are very affordable. Yeah, great food. Right?
Whereabouts is that?
Gladesville, that kind of area.
Okay. Yeah. Excellent. And Gary, if someone's going to jump onto the Geometrica website and maybe look through some of the case studies that you've got on there, what ones would you highlight? What ones are the most memorable to you?
So I kind of wear two hats, and one is as a portfolio manager, and the other one is as analyst. And so I tend to lean to the ones where the analytical challenge has been big, and it doesn't necessarily translate into P&L and scale of P&L. But I thought we did really interesting work on A2, and that wasn't just me. That was my colleagues Ben and James, who did pretty amazing work. James in particular on the data side, and Ben on the accounting and logic side. But I like their work on First Solar, which is a solar company, because there was a lot of fundamental concepts in structural concepts like cost curves and fun things like that. I like that one. I like the turnaround ones, which are slightly big and messy and take time. Because what I find is everyone shies away from situations of leverage in a company or where they've gone through some crisis. But those can be the most amazing investments. And Carnival Cruises is not an Australian business, but if you hearken back to QBE and, a terrible period of 9/11, it's analogous, because after that, 9/11, a lot of the insurance industry did it tough in commercial/underwriting space as well, because there were massive losses. But the industry was relatively consolidated in an Australian context at that time. And so if you have a consolidated industry and a large profit hole, the only way to rebuild the balance sheet is through the P&L. So you just effectively harvest profit to repair your balance sheet. And that's what QBE did. And with the cruise companies, we invested in RCL first at around $80, and people thought we were late.
Is that Royal Caribbean?
Yeah, that's right. And we had an initial price target of 160, and people thought we were crazy. We got off it way too early because the thing went through 300, right? So those recovery ones that are long cycle and have complexity of balance sheet and P&L and structural dynamics, they're kind of fun. I find them fun. Most people wouldn't find them fun.
It's funny. I find we've come full circle in the conversation, where if you think back to the bonds, the Brealeys, etc., doing these complex things, and that's what you looked at and said, that looks like fun. And it's now we've come full circle, running your own fund, and when you're handpicking out some of the things that you were quite proud of, it's those more complex situations.
There's an element of truth there. I would just throw in my defense that it's when the complexity distills down into simple numbers that you can explain, then I think you're possibly onto something.
Yeah. Fantastic, Gary. I've really enjoyed this conversation. I really appreciate it. I'm going to put some links in the show notes just to some of these case studies that we've talked about so people could follow them up and have a look at the data for themselves if they like. But I really appreciate you stopping by.
Thanks, Mitchell. Thanks very much for your time.
Thanks for watching this episode of the podcast. If you want to hear more from us, you can get daily videos and podcasts on Rask's YouTube channel. Or if you want to enroll in a free course on investing, property, business, money, you name it, you can join over 34,000 other students and enroll in a free course on the Rask website. Simply head to www.rask.com.au and follow the prompts. Thanks for watching this Rask podcast.